Today is Monday, September 9th, and this is the ADM Investor Services weekly market kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, Mark Bowman, and JP Snyder from the ADMIS Research Department. Starting with the grains this morning, Mark Soderberg, what are your expectations for Friday's USDA reports?
I've got old crop corn ending stocks falling 20 million bushels to 1.285 billion as I look for slightly higher exports and a slightly lower corn usage for the production of ethanol. For the 2025 crop, I've got production at 16,410 million bushels. That's down 332 million from the USDA estimate in August. My yield works out to 185 bushels per acre. That's still a record high yield, however, down from the USDA forecast of 188.8 in August. I've got new crop ending stocks at 1.815 billion, so that's down just over 300 million bushels from the USDA estimate last month. In beans, I've got old crop ending stocks falling just a little bit, down 15 million bushels to 315 million. That on a slightly higher exports and usage for crush. My production forecast at 4.260 billion, that's down 32 million from the USDA in August. And I've got an average yield at 53.2. Part of that lower production likely to be offset by lower demand. I've got ending stocks, however, dipping 15 million bushels to 275. Right now, I'm not in the camp of thinking that U.S. exports will just all out collapse here without a trade deal with China. Yeah, we'll probably drift lower, but I've got them at 1.675 billion. That's down 30 million from last month, and that's already at a 12-year low. USDA will not provide updates on wheat production this week. However, they're waiting to the end of the month and the small grain summary on the 30th. I don't see any changes to the wheat balance sheet. I think an argument could be made for higher exports, given a pace right now we're at a 5-year high. But USDA raised at 25 million bushels last month. I think they're just going to sit tight here this month.
Mark, you mentioned that you don't think U.S. bean exports will collapse without or with a trade deal with China. Why is that?
As many of our viewers realize, global soybean trade is dominated by two suppliers, U.S. and Brazil. Together, they account for about 85% of the global soybean trade. Over the years, this has shifted to Brazil, supplying about 60%, USDA down to about U.S. down to about 25%. China is a dominant buyer, accounting for about 60% of the global trade on the buy side. Right now, the USDA has Brazil exporting 112 million metric tons of soybeans for the 25-26 marketing year, with the U.S. at 46.5 million metric tons. China, as a dominant buyer, they're forecast to import 112 million metric tons, equaling the Brazil's exports. So in my view, the more beans that Brazil ships to China, the less they'll be able to sell to everyone else. The rest of the world is forecast to import about 72 million metric tons in this 25-26 marketing year. So, yeah, China will likely pick up a little more buying from other countries in South America if a trade deal is not struck with the U.S. this fall. But I just don't see it having a dramatic shift in the overall supply and demand on the global balance sheet. I think weather in South America will have bigger impact on their overall production than whether you get a trade deal done with China or not. Brazilian soybean plantings are just getting underway. Most acreage estimates are coming in about 1% to 2% above a year ago. The USDA is at a 3% increase. I think it's going to be closer to that 1% as global weakness right now in the ag economy. It's going to impact everyone. Agribusiness loans in South America, in Brazil right now, are spiked to almost 4%, up from just over 2% a year ago. So that's why I'm leaning towards a little bit on the low end of that acreage increase.
Thank you. Mark Bowman, sticking with Friday's USDA reports, what do you look for regarding the cotton market?
So we have seen a slight decline in crop conditions fall since July 31st. Now we're down to 51% good to excellent from 55% as of the end of July. This does suggest we could see a modest decline in production, perhaps, down maybe about 600,000 bales to 14 million even. Keep in mind, though, that our the average is 44% good to excellent. So at 51%, we're still well above average. The other point is this: we've had very slow export sales so far this season. Marketing year just began on August 1st, but going into the year, we're still at the lowest in 10, 12, 11 years. And so this does point to possibly a drop in exports in their forecast as well. Cumulative sales now only 32% of the forecast versus 48% for this on average for this point in the marketing year. So we're well below. Last year we were at 40%. So we're even twice lower than we were a year ago relative to what's expected. So I'm thinking last year they lowered it by 200,000 bales in the September report, and so maybe we'll be looking at a 200,000 to 400,000 decline, and that could be enough to offset any decline in production.
And Mark, shifting toward the energy markets, the OPEC plus countries raised production again over the weekend. What does this mean for global supply?
So yeah, they did increase it. They increased it by 137,000 barrels per day for the month of October. That's smaller than the increases they did in September and August, which were 550,000, and July and June there are 411,000 barrels per day. So it is much smaller, and that as a result, we did see a little bit of a rally today. Now, when I say they raised production, it really means they're lifting their quotas, they're lifting their restrictions, and what they've done now is they've completed lifting a total of 1.65 million barrels per day. I'm sorry, 2.5 million barrels per day since April. They did that through September. So now they've actually started to begin lift another tranche of 1.65 million barrels per day. And that's more than a year ahead of schedule. So it does point to more production down the road. Now, one limiting aspect is that even though they're lifting their quotas, it doesn't mean they're lifting production that fast. Some cases, some nations have reached their limits of current capacity, so they need to expand. In other cases, this only allowed them to actually move into. They were already producing ahead of quota, so it only has allowed them to move into compliance. But overall, it seems like Saudi Arabia is going after market share, will accept lower prices in the process, and this seems to point to higher supply down the road.
Thank you. JP, looking back on last Friday, what did the labor report tell us?
Friday's labor report was relatively weak, as I'm sure everyone is aware, but if it weren't for gains in the health services sector, the labor market wouldn't be growing at all. Job growth continued to slow in August. We saw just 22,000 new jobs added for the month. That was well below expectations of 75,000 new jobs, and added to a summer of slow hiring and signs that are pointing to a stagnant job market. Revisions to June's data as well show that the economy lost a net 13,000 jobs. That was the first net decline since December 2020. The losses in August were widespread. The report was showing drops in employment across sectors, including manufacturing and finance. Unemployment rose to 4.3% from 4.2%. That is still relatively low, suggesting that immigration restrictions are crimping the supply of available workers. But so far in 2025, the economy has added an average of about 74,000 private sector jobs per month. Take away the roughly 64,000 jobs that health services have been adding each month, and the remainder of the private sector has been contributing about only 9,400 jobs a month. Healthcare and social assistance tends to add jobs no matter the economic conditions, given their importance. Now, the U.S. has added just 598,000 jobs so far in 2025. Outside of 2020, when the pandemic hit, that is the fewest for the first 8 months of the year since 2009, when the economy was buckled by the financial crisis. Looking forward, the report cemented expectations that the Fed will cut rates at its meeting in September, and has also fueled speculation over a potential 50 basis point rate cut as well, although that seems unlikely. What does seem more likely, though, is that the report has led markets to expect a series of rate cuts from the Fed. Fed fund futures are showing markets have priced in a 79% chance that the Fed will cut rates again in October. Looking for clues for the amount of easing we could see from the Fed this year will be Wednesday's producer price index inflation and Thursday's consumer price inflation data, for an update as to how tariffs have affected prices and what it could mean for the Fed's dual mandate.
And lastly, JP, what can we expect from the European Central Bank's policy meeting this week?
Yeah, the European Central Bank meets on Thursday, and it is expected to leave its key interest rate unchanged for a second straight meeting. But notably, the bank is also expected to give very little guidance in regards to its next moves on interest rates in the coming months. The ECB is the first central bank among its peers to reach its 2% inflation target after the 2021 surge in inflation that saw inflation peak at over 10%. Policymakers at the ECB, including its president, have said that the bank is now in a good place regarding their policy stance. Economists at the ECB are also likely going to stick with their forecast that inflation will fall below the 2% target in 2026, but tick higher again in 2027, indicating that there is little or no reason to change policy. But how now weaker than expected growth as a result of higher U.S. tariffs, a stronger euro making European goods more expensive for foreign buyers, and a flood of cheap Chinese imports could push inflation further below target than currently anticipated in 2026, and also threaten to keep inflation under its 2% target in 2027. That would warrant further rate cuts. However, a stronger rebound in activity, especially as governments ramp up spending on defense and as Germany repairs its freight infrastructure and makes a lot of investments in the infrastructure there, could push inflation higher. So the outlook for the ECB remains fuzzy, given all the unpredictables in the market. And as such, policymakers will likely acknowledge that inflation could be both higher or lower than forecast, and that the path for interest rates will depend on which of those two risks materialize.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.